Banks are banned from selling silver, and yet almost no one can explain when it happened, why it happened, or what it really means. Because if this were truly insignificant, it wouldn't be buried in regulatory language, it wouldn't quietly reshape bullion markets, and it definitely wouldn't coincide with silver flirting with levels most analysts once laughed off. The real mystery isn't whether silver could hit $100. It's why the doors that used to supply it are quietly being locked right now. Welcome to Cash Historian. For decades, we were taught that banks sit at the center of every major market. Stocks, bonds, currencies, commodities. If something is important, banks are involved. If something is liquid, banks make the market. That assumption feels natural. It feels safe. But silver breaks that assumption in a way almost no other asset does. And the story of how banks were pushed out of selling silver is not a sudden ban, not a headline announcement, but a slow regulatory squeeze that only makes sense when you trace the history of money, leverage, and trust itself. To understand why this matters now, you have to understand how silver stopped being treated like money, without ever stopping being essential. For most of Western history, silver was the people's money. Gold settled international accounts and financed empires, but silver bought bread, paid wages, and circulated daily. In the United States, the Coinage Act of 1792 fixed the dollar to both gold and silver, embedding bimetallism into the financial DNA of the country. Canada followed similar metallic standards under British influence. For more than a century, silver wasn't an investment. It was infrastructure. That began to change in the late 19th and early 20th centuries when industrialization exploded demand for capital. Banks grew larger, credit expanded, and metallic constraints became inconvenient. Governments wanted flexibility. Wars demanded funding. Social programs demanded permanence. Silver, once trusted, became a problem to be managed. By the 1930s, gold was pulled from circulation in the United States. Silver lingered longer, but its role was shrinking. By the late 1960s, silver was removed from U.S. coinage entirely. Canada followed shortly after. Officially, this was modernization. Unofficially, it was a quiet severing of money from metal. But silver didn't disappear, it was repurposed. As currencies floated freely, silver became an industrial input. Photography, electronics, medicine, chemicals, and eventually energy. The more advanced society became, the more silver it consumed. Unlike gold, which mostly sits untouched in vaults, silver gets used up. Once it's embedded in circuitry or solar panels, it rarely comes back. This distinction sets the stage for everything that follows. In the post-war period, banks increasingly treated silver not as a physical commodity, but as a financial instrument. Futures, forwards, swaps, and unallocated accounts allowed banks to sell exposure to silver without ever touching metal. This worked as long as confidence held and physical demand stayed manageable. The rise phase begins quietly. By the 1980s and 1990s, financialization had reached commodities. Banks could create paper claims on silver far exceeding the amount of metal available. This wasn't illegal. It was standard practice. Just like fractional reserve banking with cash, bullion banking operated on the assumption that not everyone would ask for delivery at once. For years, this system appeared stable. Prices stayed relatively low. Physical demand grew steadily but predictably. Mines produced enough to meet needs. Western economies benefited from cheap inputs, and silver remained an afterthought for most investors. Then the world changed. The 2008 financial crisis shattered trust in leverage. Banks that were too big to fail were revealed to be too interconnected to survive without government rescue. In the United States, taxpayers absorbed the shock. In Canada, banks fared better, but only because of tighter regulation and a housing boom that masked deeper fragility. In the aftermath, regulators turned their attention to derivatives. Leverage was no longer a theoretical risk. It was a political liability. This is where silver quietly entered a danger zone for banks. Precious metals derivatives, especially those tied to physical delivery, carried unique risks. If counterparties demanded metal during a crisis, banks could be forced to source silver at any price or default. Regulators understood this, so they began to tighten rules, not with dramatic bans, but with capital requirements, liquidity coverage ratios, and balance sheet penalties. Basel III, implemented in phases through the 2010s and early 2020s, fundamentally changed how banks treat commodities. Unallocated precious metals positions became expensive to hold. Physical metals carried different risk weights. Suddenly, selling silver exposure wasn't nearly as profitable as it once was. Banks adapted by stepping back. They reduced market-making activities. They closed retail bullion desks. They exited physical silver sales altogether in many jurisdictions. In the United States, major banks stopped selling silver directly to the public. In Canada, similar trends emerged. Officially, this wasn't a ban, but functionally, it achieved the same outcome. The breaking point arrives when industrial demand accelerates at the exact moment banks retreat. The energy transition changed silver's demand profile permanently. Solar panels alone now consume a massive share of annual silver production. Electric vehicles, charging infrastructure, and grid modernization all require high-conductivity materials. Silver is irreplaceable in many of these applications. At the same time, mining output stagnated. New silver mines are rare. Most silver is produced as a byproduct of copper, lead, and zinc mining. When base metal demand slows, silver supply suffers. Environmental regulations in North America tightened. Permitting timelines stretched into decades. Ore grades declined. This created a perfect storm. As physical demand surged, the paper-silver market began to look increasingly fragile. Banks, already constrained by regulation, had even less incentive to provide liquidity. Selling silver became a reputational risk. A delivery failure could trigger lawsuits, regulatory scrutiny, and balance sheet stress, so banks stepped aside just as demand exploded. The fallout is subtle but profound. Without banks acting as intermediaries, the silver market becomes thinner. Price moves become sharper. Premiums over spot widen. Retail investors notice delays and shortages. Industrial buyers lock in long-term contracts. Governments quietly monitor supply chains. In the United States, inflation debates dominate headlines. But beneath CPI prints lies a commodity story that doesn't fit neatly into monetary models. Silver prices feed directly into energy costs, medical equipment, and electronics. Higher silver prices don't just hurt investors, they ripple through the real economy. In Canada, the story echoes through housing and infrastructure. Renewable energy targets collide with rising material costs. Provincial budgets strain. The Bank of Canada, like the Federal Reserve, talks about normalization, but commodity-driven inflation complicates the picture. And hovering over all of this is the psychological shift. For decades, investors assumed silver would always be available. That assumption is breaking. When banks won't sell silver, not because they're forbidden by law, but because they're forbidden by risk, the message is clear. The system doesn't want the exposure. This leads us to the failed fixes. Policymakers suggest recycling will solve shortages. It won't, at least not quickly. Recycling silver from electronics is expensive and slow. Others suggest substitution. But silver's physical properties make substitution difficult without sacrificing efficiency. Some argue higher prices will bring new supply. Eventually, yes. But mining is not a switch you flip. By the time new mines come online, years have passed, and demand has moved on. Meanwhile, paper markets continue to promise liquidity that physical markets can't deliver indefinitely. This gap between paper and metal is where volatility lives. It's also where confidence breaks. Now connect this to the present moment. Silver pushing toward triple digits isn't about hype. It's about timing. The window where silver could be acquired cheaply, easily, and in size is narrowing. Not because of a single event, but because of accumulated pressure. Banks exiting silver sales removes a stabilizing force. Industrial demand accelerates. Monetary uncertainty lingers. Government debt in the United States surpasses $35 trillion. Canada's household debt remains among the highest in the developed world. Both systems rely on trust. Silver historically thrives when trust erodes. This doesn't mean collapse is imminent. It means the margin for error is shrinking. And that brings us to the core insight of this entire story. When banks stop selling something, it's rarely because it's worthless. It's because it's dangerous to promise. So before we end, let's make this clear with 3 takeaways. 1, banks didn't abandon silver because demand disappeared. They abandoned it because risk reappeared, and regulation made that risk unprofitable to carry. 2, silver's price isn't just about speculation. It reflects a structural imbalance between industrial necessity and constrained supply. The narrowing window toward higher silver prices isn't driven by fear, but by timing. Once physical availability tightens enough, price becomes secondary. Here's the question you should be asking yourself. If banks no longer want to stand between you and physical silver, what do they know about the future of delivery, liquidity, and trust that most people still ignore? If you want deeper context, hidden financial history, and stories that connect yesterday's monetary decisions to tomorrow's consequences, you're exactly where you should be. This is Cash Historian. Like this video, subscribe to the channel, share it with someone who still believes banks always provide safety, and comment below with your perspective on whether the silver window is already closing.